Welcome to another episode of the IBC Guys. So I'm Dave. Mr. Stevens, Mr. Mike Stevens is not here this evening. His boys have 2 weeks left at home for the summer before they head out. They're actually both playing basketball this year, big time basketball players. So they are headed out August 1st. So joining me tonight to fill in so I'm not talking into an empty vacuum is Tim Scheinder. Tim, thanks for being back with us.
Yeah, of course. My pleasure.
So I will say this. There's a lot of things that I like about you. A lot of reasons you're in demand. The first and foremost is probably your wife. I like her
That makes sense.
and her cinnamon twist. So that's probably the biggest reason we like Tim Schneider. But the second reason, and that's a complete joke for everybody listening. But the second reason is Tim has been graciously, I would say, boots on the ground for the podcast. So Tim has been talking with people, getting some feedback, and he's kind of brought that to the table. We mentioned this, I think, the last couple episodes we did, and had some ideas that, hey, this is what people would like to know. So one of those topics is tonight. So the topic is taking a loan out. What does that look like? Is it the same as going down to Chase Bank and getting a loan? I'll answer that implicitly right off the bat. The answer is an emphatic no. But what are the differences? What is the actual process? What does it look like to pay back a loan? Do I have to pay back a loan? So Tim and I are going to kind of talk through those things. Both of us have done loans through our respective policies. So again, try to bring some implementable, actionable ideas and perspectives. So Tim, let me jump in and do all the podcasty stuff, and then we'll get rolling. So the podcast exists for three reasons. First is to get IBC information out there. What is it? What does it do? How can we use it? And we want people to be as knowledgeable as they can be to make the best, most informed decision they can for their families. Whether you choose to do it, whether you don't choose to do it, happy to help either way. We want you to make a decision that's best for your family. Two is to bring those actionable, implementable examples. So today is going to be one of those. We're trying to get a little more in depth. What does this look like in action? We're going to talk about that as our discussion today. And then third is to get it out to as many people as we can. So share it with whomever, if you would forward it. I got notification that someone from California was listening. I didn't know this traveled that far, Tim, but it was kind of cool to get that message. And they said, hey, we're shopping around IBC. So if you're listening, you didn't know that was a thing, other people do this. Be happy to talk with you. I offered to her, I had met her previously in a different business capacity. And I said, hey, if you just want a friend to bounce ideas off of, great. If you're listening or watching and you want the same thing, no expectation of doing a policy with Mike or I, we'd be happy to help you think through. This is what I see in this policy that someone, is illustrating. Happy to do all that. But to get out the information out as much as I can, or as much as we can, excuse me, is the third goal of the podcast. So we have emails, Dave at familybankingsolutions.com. Mike's is Mike at familybankingsolutions.com. If you're like me and really, really like Tim, we can get you in touch with him, but you have to, again, go through the gatekeepers and us. But we have a phone number, 507-205-2284. If you call that number, either Mike or I will answer it. So you're not going to, talk to an assistant or somebody overseas or something like that. Be happy to chat with you. Hopefully help you get down the IBC road a little bit further if you were able to reach out. All right, Tim, that's my least favorite part of doing this. It's necessary. I just I like talking to you. I like talking to Mike, and I like talking IBC. So that's what we're gonna jump in and get going on. The loan process. You can take loans from your policy. It's really one of the big cruxes of this whole thing. Get your money on the ledger, and then you can borrow against the cash value, is what it's called, and go use it in capacities or ways that you were already going to do. Your favorite example is vacations. Mike's favorite example is buying a truck. I like to ask the question, what rate of return are you getting on your groceries? All three examples are money that when you spend them, people understand that money leaves your family forever. IBC works to reverse that, but to accomplish that, you have to take a loan. So I'm kind of trying to set it up here. If you would, maybe talk us through your experience of taking a loan, Tim. What did that look like? Just kind of give us an overall general idea of what that entails.
Yeah, and I think in order to start that conversation, a picture sort of needs to be painted of what that looks like to a regular loan process versus the
It's a
IBC
great point.
process.
Yeah.
And I think, most people have some sort of relationship with a bank, or, probably bought a vehicle, or, needed a personal loan of some sort over the course of time, maybe a mortgage, things like that. But we can think about that process and how that typically goes. And, first of all, you need to choose a bank, and maybe you're going to look at a few different ones, and they'll have an application process, and that usually entails sharing
Yeah.
your
Yeah.
most intimate details, your
Everything. Yeah.
social security number, and how much money you make, and what's your address, and do you own or rent, and how long have you lived there, and all those sorts of things. And of course your credit rating matters, and that may affect your interest rate and those types of things. And ultimately you get to a point where you're a viable candidate for a loan, but only if you have
Yeah.
something in mind as collateral to secure that loan, like a vehicle. And if it's going to be a vehicle, it's what's the VIN number, and what color is it, and what model and make is it, what how many miles are on it, all those sorts of details that go into the decision making process to see if you can in fact borrow that money and earn the right to pay it back with interest.
Yeah. Earn the
And
right.
ultimately the biggest part of that is earn the right to pay it back with interest to someone else, where you will never see that money again. You're
Yeah.
trading, you're trading that earned right to pay the money back for whatever it is that you're choosing to take home, whether that's a vehicle or vacation, whatever you're borrowing the money for. I think it's almost comical, the contrast in what we're doing on a daily basis with IBC, in that we talk a lot about how do you use the thing, how do you make this work, and part of that is policy loans. In order to create the cash flow system, the way to get the money out to be able to use that for whatever it is you're choosing to use it for, is a policy loan. And the drastic difference is that process, it literally entails you saying, hey, I'd like to have $10,000 to go on to an all-inclusive in Tahiti, whatever the reason is. But you don't need to tell them that. That's the cool part. Like, it's literally just saying, I'd like to have $10,000. And they say, okay, which account would you like that in? Could you please send us a form to say so? And literally, Dave we've several different companies, maybe different timelines, but typically in a few days that money is in your account. And like I said, it's almost comical, the differences. Like, they literally don't care what you do with the money. There's no questioning. There's no like, hey, what make and model is it? What color is it? How many miles are on it? They don't care. And I think one of the other neat things about what we're doing is if for instance, if you have, if it's a vehicle that it's collateralizing your bank loan, and something might happen. You're playing volleyball on the weekend, and hurt yourself to the point where you can't work and potentially are off, and maybe working at a partial income situation, and you're not able to make your truck payment or your whatever payment, and that potentially could put you in a position to have to give that thing back. That again, stark contrast to an IBC policy and a loan against your cash value is, first of all, you don't need to tell them that.
Yeah.
Secondly, there's no expectation. Like, if you cannot make a payment for a few months because of a work change or an injury or whatever the case may be, they're like, okay. Like, and it's funny to even say they're like, okay, you don't have to say anything.
Yeah.
You make a payment or don't make a payment. That's really, it's completely up to you. The reality is that's the collateral for your loan is the cash value in your policy, and that if you end up never paying that back, it's just a subtraction from the death benefit that's paid out to your beneficiaries. So certainly there's advantages to paying that in a timely manner, and handling business appropriately, and having that money again to use for the next project in your life. But there's really not a timeline that you need to stick to or adhere to in order to keep your stuff. So
Well, so many thoughts ran through my head. So the first one is I thought it was awesome that the example you gave is someone playing volleyball and getting injured. My 42-year-old behind hasn't thought about playing volleyball in like 20 years. So I don't know, maybe swinging a golf club or something like that. But playing volleyball is a good example. I don't. You've been playing volleyball? Is that how it came to mind? You getting up there
Well,
and
it is, and I feel like that's more of a like that's how most people around here get hurt is,
okay,
being, my age, your age, and
playing basketball or
participating in
something?
organized sports of some sort, like
Yeah.
softball, basketball, whatever the case may be. I'm with you. The odds of me getting hurt in any sort of organized
Like
sporting
walking up the
activity
stairs, that's how it
is
hurt. Right.
right,
Yeah.
right, much greater chance of me falling out of a golf cart than organized sports injury.
Oh, the point remains though. So that's my crazy brain getting off topic. But if we can, I want to back all the way up and kind of dissect. I couldn't have said it any better than how you just said it. But to dissect maybe kind of each part as we went down that logical train of thought, and work through each one. So let's go all the way back to the bank. Let's go to Chase Bank. I would say a good majority of the people have financed a vehicle or a home loan or something like that. That's pretty typical. So let's use a vehicle. Let's do it in honor of Mike because he loves to talk about his trucks. So let's say when you go into finance your truck to get a loan for a truck, to your point, you're talking social security numbers, W-2s. And these are all letters and numbers that people have maybe no idea what it actually means or what it does mean. But what are your qualified plans? 401ks, 403bs. What's your Roth doing? What's your K1s? I've had people at, well, what's a K1? Like all these letters and numbers, you have to give up really your first child to even qualify to get a loan. And I think the point that you made the best is that, okay, let's say you get to that point. You earn the right to borrow the money. To even take the money out, you have to tell them what you're going to go spend it on. And that then has to qualify. So they got you on both ends getting qualified. And then what are you going to go spend it on? They're regulating every single minutia little point in that. And it's pulling hairs. It's very, very time consuming, tedious, I would say intrusive for lack of a better word. They're digging into everything. And it's the experience most people go through. So I don't know if did I capture kind of what you were trying to say by using some different language? Is that an accurate synopsis?
Yeah, absolutely. And I think intrusive is a good word. Like you really need to, they're into your whole life to make sure that you can pay back a car loan. I
Yeah.
mean, it's just like when you think about it, it's sort of overboard. you
Yeah,
know,
yeah, it's over.
and I'll qualify it a little bit. Like I'm somebody I like cool stuff, so I have a very hard time having vehicles that are very old, and I know that's not good financial advice. Please don't remember that piece from this podcast. But I've had a good, better than good. I've had a really good relationship with local bank here, and an ability to do some things that are a little bit creative, especially going back a couple of podcasts to the story that I told about
Yeah.
when Jackson was sick and passed away, that certainly there were times where we had to be a little creative with things to be able to continue on, and certainly a good banking relationship was part of that. We didn't have to worry about giving up our stuff like I had mentioned a little bit ago. Like that was, so I don't want to sit here and make it sound like that's a terrible thing. That's 99% of the world's only way to go about this. And certainly there's regulations that need to be followed and things like that. But at the end of the day, we believe we've got a better way to do that.
And I think you bring up a great point. You and I, Mike, do not have anything against banks. We run our business through Chase Bank, and we have a great relationship with a fellow down there. Like we walk in, he's like, "Hey, how can I help you?" Like he knows who we are. It's been a great experience. To your point, though, when you take that process that 99% of people have, if they've taken a loan, have been through, and then compare it to the loan process of IBC, that's where our maybe our wry smile comes from. They are drastically and dramatically different. So let's unpack that portion. I think I mentioned already, you and I have both taken loans from our policies. So I'll go through maybe the actual steps it took me. So to get a loan from, we funded it, the premiums for the year. Annual premium will go in. So it funds what's called the base and the paid up additions, the PUA, and that builds my bank for the year. And then for a loan, if I want to, like my littlest is going to have to get braces. Let's use him as an example. If I want to take $3,000 out for braces, I go online, I go log into my policy, click a form button. It opens it up in DocuSign. I type in exactly how much I want and what bank I want it to go to. I click sign and I click submit. I get an email that says, hey, this has been submitted. Thank you. And in 3 to 5 business days, that money is in my account. That's it. That's all I had to do. To Tim's point, they didn't ask where it was going. They didn't care to what bank account. That was all my responsibility. There was no questions. I didn't have to qualify. The qualification was the cash value I had put in and the fact that I am a living human being. Because my death benefit, when I pass, and I'm going to pass, that would settle any and all debt if there was ever a problem with a loan payback or anything like that. They just don't care. So the process is almost laughable in terms of time and jumping hurdles and gatekeeping and all that compared to a traditional loan. So I don't know. Do you want to share maybe what your experience? How did my experience differ from what you've had to do to get a loan from an IBC policy?
And as you're telling that, I was like, there's not going to be a contrast story to this. Like it's very
Okay,
much the
yeah.
exact same thing. Yeah, I mean, absolutely.
In different
And
companies, right? Our
maybe
policies
there's
are
a
with
paper
different.
form.
Well, yeah, they're different companies too. So yeah, paper form, online. But I guess my point is, regardless of who you go through, and Mike and I are not captive agents. We write for the client and we choose the best company for that respective person. So we bid out people against each other. So I'm sorry I'm interrupting you, but yeah, I just wanted to make sure it was clear that we're doing and using policies from different insurance companies. So you said I cut you off. Tim, Mike is mad at me too. You're not mad at me, but
No,
I'm annoyed with myself. So I'm sorry I cut you off. But you were talking about the
no.
policy process.
Yeah, and it really it's exactly the same thing. Like I think sometimes in the past paper copies have come into play, but it's very much the exact same thing. Get the information as to what you need to the company. The company will put those funds in whatever account you choose to have them deposited in a few days. So very, very simple, very easy, just like you said, no questions asked. I did, while you're talking, I did think of something, and I think it kind of goes without saying, but just in case it doesn't, like, the one thing you can do at the bank is you can go and ask for any dollar amount where, in these policies, if you have, for instance, $1,000 of cash value, you can't go ask for a $50,000 loan. Like,
Yeah.
I don't know if we've really ever said that out loud, but the thought process here is we need to capitalize that policy to a point where it can support whatever it is that we choose to do with it in terms of, buying a vehicle, going on vacation, all the examples that we've used in the past. That cash value has to be there before we can, use it.
Well, that's a great point. Let me give you an example. I talked with someone today who's looking at doing a policy and they want to run their taxes through there. So they're federal taxes, not state taxes, just federal. And their tax implication every year is around $12,000, which breaks down very beautifully at $1,000 a month. So they are going to your point, monetize like a jukebox. It takes money to play, but they're going to put $1,000 in each month. And then when tax season comes around, they're going to ask for a loan of $12,000, which is great because that's how much cash value they have in there. And then they can take and go pay their taxes with it. But at the same time, that $12,000 remains in the ledger. So the next year, they're going to put $1,000 in a month. At the end of that year, they're going to pay their taxes at $12,000, but there will be $24,000 on that ledger, making a dividends and interest and an internal rate of return. So as they continue to do it with, death and taxes, what's the saying? There's 3 of them. I don't know what always comes about: death, taxes, and something. I'm looking stupid on the podcast. Doesn't matter. Taxes are going to be paid every year. People pay them. So they're just monetizing the money they're already going to spend. And over the course of 20 years, every dime that they have put into their taxes and paid to the federal government is going to be available to them as more cash value. They can take that out and go use it again. So that's a great example of what Tim was just describing. You can only use, you can't ask for any amount, but we absolutely can design these policies for a given purpose. And I think it goes back to the statement, Tim. It's not how, or excuse me, if IBC can fit in to your life, it's how can it? And that how is very dependent on the client. People can do a myriad of different things with these. That tax example is just one. I've shared how I run it through my land business. You've shared your story, use it a different capacity. So how you choose to use it is dependent on the client. But to go back to the example today, the loan, the insurance company is not going to ask how that money is being used. So you can design it for a specific purpose and then go use it without any questions asked. So I got one more thing I want to talk about, but I want to see if you got anything to add to what was just said.
Yeah, and I think when you talk about federal income taxes, like if you want to watch somebody vapor lock, that would be the question I would ask. Like, what is the rate of return you're getting right now on your federal income taxes? And if that doesn't make someone scratch their head and wonder what we're up to, I don't know what would. You know, I mean,
Or
it
yeah, how
really,
that money is being spent, whether you agree with it or not. That's a whole other rabbit trail. But
yeah.
another person, so not the same person I just discussed, but their CPA, any um money they were going to get back every year, the CPA was just saying, government keep it. That is making 0%. It's not doing anything for them. So my question was, why not take that? Let's put it in your policy, let it sit there. It gets on the ledger, then you go use it, and that just builds over time. So we just kind of talk through strategy that way. But to your point, yeah, that's a great example of let's monetize money that maybe you don't agree with how it's going to be spent, but you have to spend it. Kind of thinking. All right, so let me jump back. We talked about the traditional loan, how to get a loan, but the last piece I want to make sure we discuss implicitly is the fact that when you take a loan, you are the bank in determining how you're going to pay yourself back. That's a long-winded answer, Tim, to say you can do it anyway in any time frame that you want. So you already brought up, let's say you get injured playing volleyball. I'm jumping 10 feet in the air, spiking these things straight down, but somehow, some way I land on an ankle and snap. My professional volleyball career is over. What am I going to do now? If I have these loans out and I'm not getting paid, the insurance company says, huh, that's sad. Get better quickly. Pay us when you can. There is no time frame. You don't have to do it in any given context. So why don't you talk through in your experience what that's looked like for you?
Yeah, I mean, in our example, it was all debt based, at the when I've used the policy that we had originally, that's kind of the example that I illustrated in the podcast 2 episodes ago. It's a little bit different because it continued to like metamorphosize throughout that process and where I could put funds and where I couldn't. And
Yeah.
we'd borrow we each year we'd borrow what we could and pay off a certain thing and direct money a different way. So those, in that case, the payment that we were making to the insurance company could increase over time too, as more money became unencumbered to the
Yeah.
to the debtors that I had out there. In the first place, I could put more money back into the policy too. It's hard. It's kind of hard to explain that process specifically. But it just it wasn't a static thing, which I think is the point here. I mean, it doesn't need to be an exact science. If you borrow something and you want to have $100 payment each month, you can do that. If you want to have a $500 payment each month, you can do that on the same exact loan. So I mean, to your point, it was a little bit different at that point, but it very much illustrates the point that that's not, it's not static. It's a very unique way of cash flow, where you can kind of be the master of that whole situation.
Well, yeah, I'm gonna try and say what you said, maybe in a different way. So
Hopefully better.
while you put the money in there, that's making you money. It's staying on the ledger, even though you're borrowing it out, and that blows people's minds. It's almost inconceivable based on how most people are taught. But that money stays in the ledger, and as you do that over time, that money continues to grow uninterrupted, and it's gonna be, it's just gonna exponential growth. So you give it 5, 10 years. When you put that, let's say $1,000 in for your year. Let's say it's a little guy policy, which is great. $1,000 in for the year. Let's say the 10th year, and I don't know the exact numbers. It's based on several different things, but you'll be able to take out $2,000 because you have $11,000 in that 11th year, making you dividends and interest and an internal rate of return. So not only that, but as you've paid back your policy, as you borrowed and paid your debtors back and then refunded your policy, and again the fluidity of the money, you're playing, call it not a shell game, the money goes to where it needs to go, but the fluidity of the money, the more you can put in, the faster that's going to grow. So you give it a few years and you've kind of reversed the flow of money away from your family back to your family just by running it through this cash flow system. Is kind of maybe how it's the same thing you just said, is maybe a different way to say it.
Yeah, and I think honestly, Dave, you probably said it better than I did, to be
I
honest.
don't
I think looking back at that time, the reason it's a little bit harder for me to explain that example versus like something easy like a vehicle where it's a fixed period of time and you've got a fixed amount of money is that we were also capitalizing that policy at the same time. So what
yeah,
you just said about like, as that policy got older, more money became available to use, is a super important point. You talk about like somebody building a policy for their cell phones, their cell phone bill in the short term. While, 10 years later, that policy could just as easily be used for something much bigger, a bill that's a
yeah.
lot larger because now you've got more money available to use, in a policy loan situation.
Yeah, let's say again, let's use 10 years as a nice round number. You put $100 in for your cell phone bill for that month, you're able to take out over $200. Well, I just put 100 in, but because that has grown uninterrupted, I can take 200 out and maybe that starts to supplement mortgage, or maybe that's your groceries
Mhm.
for the week. So not only does it pay your cell phone for the month, but it's your groceries for the week. And no one's in this day and age eating for $100 a week. Maybe you're a single guy. This is a good example for a single guy. Maybe that is the case. I don't know. I haven't been single for a little while. But to your point, that is a big piece of it. And then as that, you're just reversing the flow of money away from your family back to your family. And you give that thing, let's not say 10 years, let's say 40 years, and you're talking legacy building wealth. And then especially like we have done with our kids, my kids' policies by the time they're my age are going to have that cash value already embedded. And then my trust is going to dictate how that's used and things like that. But then when they pass away, my kids, that death benefit then goes to the trust and it's going to help my grandkids. So that stuff gets me going. That's a lot of fun. But that's not the topic for tonight. So I got to not rabbit trail, Tim. But excuse me. Yeah, I think people get hung up on two main components of this. One, when you put the money in, it stays in the ledger, even though you're going to use it for what you're already doing. That is hard to comprehend. And that took me a long time to wrap my mind around the fact that that's actually happening. If I put $10,000 in and then go borrow $3,000 for braces, I have $10,000 on the ledger making me dividends and interest, because this $3,000 really doesn't matter, because it's just going to be taken off the death benefit when I pass away if I never pay it back. But I'm still making dividends and interest and an internal rate of return on $10,000. That's the first thing that gets really hard to understand. The second component is that I don't necessarily have to pay it back if I don't want to. And that's not a good idea. That's not a, a good way to go about it. You want to put the money back in because it's going to decrease what's called the drag on your policy. But you also get to do the same thing with it as you continue to fund your premiums. You can take it back out and do, it's like a checkbook in that capacity. Take it back out and do something else with it. The difference is that ledger continues to grow. But if you get to the point where you can't pay it back, your death benefit when you pass away, it could be 30 years later, that is going to satisfy any outstanding debt that exists. So you get to choose. I'm going to pay, I can't pay the $500 I usually pay. I can only pay 100. Okay, great. Pay the 100, pay the 500 the next month, or I can't do it this month. We can't swing it. Land business. I haven't sold any property. That's maybe a discussion my wife and I would have. Okay, we don't pay it back. So next month, maybe we try and make up for the missed month, but we don't have to. The flexibility and the fluidity is really hard for people to understand. So the fact that the money stays in the ledger is really difficult. Got to wrap your mind around it. But then the flexibility and fluidity of paying back your loans, I think, is the second very difficult thing to wrap your mind around. Would you agree with those two things, or you think maybe something different?
No, I do, and I think I'll do a Dave Parmalee trick here, and I'll try to
Ah,
say what you said a little differently.
perfect.
So I think we need to be super careful, and I actually think this helps people understand what we really mean when the money stays on the ledger. We need to be careful about, how we differentiate or say take a policy loan.
It's very true. Yeah.
I want to say like it's not, you're not taking the money out of your policy. You're not borrowing money out of your policy. It's not like I'm going to use my money, out of that policy. Some people do say that that they explain it that way, and that's not actually the case. Like the situation that creates the ability to have a policy loan is the money never leaves that policy. It just creates collateral. So the cash value of that whole life policy is the collateral for the loan. And in this case, the guaranteed rate of return and the dividends and all those things like that happens because the insurance company is investing that money and finding the best way to get the return on their investment to be able to pay these things, pay the internal rate of return and the dividends and have a good successful product. But in this case, the first position or the first person in line to have access to that money, as a loan in this case, is the policy owner. So basically,
Yep.
you're in first position to be able to say like, you know what, in this case, I'd like to borrow that money and I'd like to pay some interest on that and help us as a group be successful. So it isn't money coming out of the policy. That's why the money can stay on the ledger.
Well, I'm gonna Uno reverse that and pull a Dave Cromley trick too. But because I'm gonna use different word, the collateral, and I'm gonna say that's the ceiling. It is absolutely the collateral. I 100% agree with that. But I want people to maybe think of it as a synonym at the same time. Your cash value is the most you can borrow. So if you have 10,000 in there, that's your ceiling as well as your collateral. You can borrow 10,000 out, but it stays in the ledger because the death benefit, if it never gets paid back, will settle any and all debts. So the cash value is the ceiling and the collateral at the same time, while any debt settlement will be taken care of by the death benefit when you pass away. It's not an if. You're gonna pass away. I hate to break it to you if that's breaking news for any of our listeners. You maybe want to be thinking about something else at IBC, but you're gonna die. It sounds crass, but it's true. And when you do, that death benefit is going to settle any cash value loan that you may have. So I do think the semantics of this, Tim, the definitions, you brought up such a good point. When you take a loan, you're not taking the money out of your policy. That money stays there. You're borrowing against the cash value, and that way to phrase it isn't in normal conversation. So I need to be careful. So that's a great clarifying thing for me when I talk on this podcast. But to borrow against the cash value means that's the collateral. You can take and go use it because your death benefit will settle anything. But that money that you've put in never leaves the policy itself. It stays there. They just give it to you on loan because your death benefit would settle anything that you have outstanding. So, man, this is a good episode. We got on saying this is not going to take us very long. So we pulled a Mike Stevens and Dave Parmalee where we talked way longer than we thought we were going to. But I think this is going to be one of the best listened to episodes, mostly because Tim Schneider's on here. But two, this is a great topic. You can shake your head all you want. I think it's true. But I think this is a great topic. And it's, again, boots on the ground. What do people want to know? Let's go more in depth. I think this is a great way to go about doing that. So if this helped you, we're kind of running out of time. So I'm going to let's for the good of the cause. We got 4 minutes. Is there anything you want to wrap up with, Tim, before I close out the episode?
No, I just like you said, I think that a lot of these topics that seem mundane or quick, quick is probably a better word. Just seems like it's very easy to get through. There's so many great points, and it can really clarify what we really mean by use this policy in your day-to-day life and use this for cash flow. Like that process is so simple that it literally is not much different than writing a check. It's just simply asking and like, hey, I'd like the money in this account, and a few days later you've got that money there, and you're able to pay it back when you want to. I mean, it very much illustrates how simple and pain-free this process really is, even though it sounds sort of so different than the norm.
The process is very simple. The reason it works, I think, maybe is where people need to spend time. But encouragement. It took me 6 months, or took me a year. It took Tim 6 months. Again, we talked about that last episode. Tim's a faster learner than I am. But if we can help expedite the process, give us a call, shoot us an email. This is what we do all day, every day. Um, I think I've said this before. I'm a pretty normal guy. If you're not watching on YouTube, I have a fishing shirt on. It's not the best outfit for a guy talking about financial stuff, but I'm just Dave and I want to help people out. And that hopefully resonates in this podcast. I know Mike has the same feeling. I know Tim does too. We want to get this out there and just help people. So give us a call. My email is dave@familybankingsolutions.com. Mike's is mike at familybankingsolutions.com. 507-205-2284. We'd be happy to answer any questions. Hopefully this raised some questions. And if we can help clarify any new questions or questions you want to ask to a specific person, if you call that number, you'll get us. If you email our email addresses, you'll get us. So you're stuck with us. If you want to talk with Tim, I'll forward that bad boy as fast as I can, and he can get back with you as well. But Tim, thank you for being on. It's a pleasure to have you. Just taking time out of your evening to talk through this, but I do think this is going to be a good one that people will talk about and have it resonate with. So yeah, anything you want to say?
No, I was just going to say thank you for having me on again. It's fun. Like you said, I think a lot of these, a lot of these podcasts are fun. They're enjoyable for me, and I think they really do help people wade through, sort of this big scary topic.
Yeah, and that's the goal. And I'll say this, Mike's trying to ask for way too much salary now. It's like one of those NBA stars watching. So we'll have you on as much as we can because you're a lot cheaper than Mike. I'll put it that way.
That's for
Hey, if
sure.
he doesn't show up, I could dog on him. I think that's fair. So I'll tell him that. But if he's not here, we can have some jokes at his expense. But if you're listening or watching, thank you for joining in. Appreciate you taking the time, and we'll catch you on the next episode.